everybody. I'm David Darst, here to give you a recap of the second quarter of 2024. Welcome. Now, this past 12 weeks, we had really a tremendous outperformance by the mega cap technology and artificial intelligence related stocks. Net mega cap and technology stocks for the quarter were up 13.2%. Far outpacing many of the broad averages. NASDAQ does have many of these stocks in it. It was up 8.5%. The Standard & Poor's 500 for the quarter was up 4.3%. Now, when you look at this traditional 60-40 portfolio allocation, 60% stocks, 40% bonds, for the quarter, it was up only 2.3% because you've had price pressures for many of the broader indices as well as for some of the bond indices. The Russell 1000 growth versus the 1000 value, Russell 1000 value, the growth was up 8.3%. The value was down 2.2%. Now, as a backdrop, you had the global economic growth is moderating. Okay, it's slowing somewhat. It's perceptible. It's not imperceptible, but it is slowing down a little bit. At the same time, inflation is continuing to moderate, although at a very slow pace. It is moderating, but at a slow pace. The Federal Reserve, with this combination of factors, is perceived as moving toward easing. We have less of the quantitative tightening going on, and you have quite a bit of federal officials' rhetoric, and that would also be the case for the European Central Bank. Copper, which is a great indicator of economic robustness or lack of robustness globally, copper prices have been a bit soft, and oil has been well bid. With the backdrop, economic and geopolitical backdrop, oil has been well bid. Right now, the forecast for 2024 as a whole, we're forecasting 2.7% growth this year and 1.9% real GDP growth next year. That's for the United States. That contrasts with the Fed. The Fed is a little bit below for this year. They're 2%. We're 2.7%. Next year, the Fed is at 2.0%. We're at 1.9%. For Europe, the European Central Bank is at 0.9 and 1.4 respectively for this year and next year, 2024, 2025. Whereas our forecast is a little bit softer this year in Europe, 0.8% and 1.5%, a little bit above the European Central Bank next year. Japan, 0.9% this year. We're thinking 1% next year. China, 4.6% this year, 4.1% next year. From an inflation standpoint, the core personal consumption expenditures index, this is the Fed's primary measure of inflation that they like to focus on. In the March summary of economic projections, the Fed was expecting 2.3% for 2.6% for 2024. Now they're at 2.8%, so a little bit higher. The Fed is. And we'll get a new update of that at the September summary of economic projections. Next year, the Fed is at 2.2%. So you see that continued slow downward drift. And March, it was 2.3%. Now, unemployment has risen. You may have followed this. It's now 4.1%. In January and April 2023, it was 3.4%. So you've seen unemployment rising. You've seen inflation falling. So when you put these two things together, unemployment rising, inflation falling, that means a cut in interest rates, policy interest rates by the Federal Reserve. There's a meeting July 30th and 31st. And then the final three meetings of the year, there's no meeting in August. Instead, they have the Central Bankers Symposium in Jackson Hole, Wyoming. September the 17th, September 18th, we think there's a very, very good chance of a 25 basis point cut at that time. The meeting after that will be right after the United States election, November the 5th, Tuesday. The Fed has a two-day meeting, November 6th, November 7th, and then, of course, December 17th, 18th. Those are the final three meetings of the year after the July meeting. When inflation is dropping and the Fed is basically starting to ease interest rates, policy interest rates, you're going to see the dollar to soften a little bit, and you'll see money, we think, move from money market funds. Right now, the amount of money that's sitting in money market funds is $6.1 trillion. You could see some of that begin to move out the risk curve into more risk-oriented assets, not necessarily risky assets, but risk-oriented assets. As we think about the second half of the year, the equity valuations are elevated. They are high, both price earnings and then the three classical long-term equity valuations. You have the Buffett indicator, which is the GDP ratio compared to the total stock market. And that is in that 98th or 99th percentile of valuation. So it is very high, the Buffett ratio. You have the Shiller price earnings ratio. The long-term average is somewhere around 17 or 18. It's at 38 right now. The Shiller price earnings ratio, price divided by 10-year average inflation-adjusted earnings. And the third one, of course, is the equity risk premium. And we look carefully at that one. That looks at the earnings yield on stocks versus the yield that you can get from fixed income securities. We have this equity market concentration and lack of breadth that we talked about at the beginning, where you have the mega tech up, mega cap and tech up 13.2%, the S&P 500 for the quarter up 4.3%. So you have this tremendous concentration and lack of market breadth. Portfolio positioning, asset allocation. We favor credit over equities right now. We think the yields are generous. Equity valuations, as you know, are quite high. So we favor credit over equities. In the liquid credit area, you want to be in the high quality and in the short end. In the private credit area, there you're looking to get seniority in the capital structure. You want to look at leveraged loans, which is basically where you're getting some floating rate aspect of bank loans or loans to corporations, and wider spreads versus cash, so that you pick up. That's in the private credit area. The private equity area, we're focusing on secondaries. The last 3 years, we've had $100 billion a year of people wanting to get liquidity. Some limited partners need the money to pay out to their stakeholders, okay? Pensions, endowments, foundations. They basically are selling a portion of their equity interest, private equity interest, and we find significant values are being created here, attractive values, particularly in the middle market corporate sector of private equity. Infrastructure. We think this is a great area as an inflation protection device, especially in an interest rate higher for longer environment. The valuations, we think, are attractive in private equity. We think the income generation appeal in private credit is good. And in private real estate, you want to be very, very selective in private real estate, the debt in private real estate area. Equity markets in Japan and Europe, also on a valuation basis, quite a bit of difference between those markets and the markets in the United States. So we're basically looking also there. Thank you for being with us, and we look forward to catching up with you very soon.